Attention, all curious minds, innovators, and trendsetters. It's time to pause, lean in, and get ready for an extraordinary journey as we dive deep into the fascinating realms of life, technology, entertainment, and business. Let's explore, learn, and grow together. Brace yourselves, for the next thrilling episodes of Hipther Talks is about to take off. Counting down from 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. And here we go.
Hi everyone, Zoltan here. We're back again this week for the weekly Hipther Talks podcast. Today I have Anton Fedorov, a partner at Flashpoint VC. Hi Anton, nice to have you here.
Hi Zoltan, pleasure to be here.
So today we're going to talk about tech investment and particularly nurturing startups, strategic exits, and the future of venture capitals. But first, as we usually do, let's introduce our guest. And what better way than to ask to do it himself? So Anton, say a few words about yourself.
Sure, pleasure. Thanks for having me again. My name is Anton. I'm partner at Flashpoint. Flashpoint is a European alternative tech asset manager. Basically, we provide capital and expertise along the company's journey in building software and consumer products. We have a variety of ways to help companies from early stage when we back them with Series A product, which is a venture capital product, up to growth as they scale up, and also provide secondary liquidity later on. So basically a multi-stage investor tapping into different entry points during the life cycle of the company.
All right. So since you joined Flashpoint, I believe it was 2014, have you seen the company's investment strategy evolve? And I'm interested particularly in the realm of B2B software and tech-enabled solutions. And maybe how does this align with the current market trends in the sector you focus on, like hospitality, travel, real estate, and others?
Sure. I think there's a combination of factors that influence, but first and foremost, we're a generalist fund. So we don't have any specific sector that we only focus on. There are funds that only do, for instance, like prop tech. There are funds that only do like gaming or infrastructure and data and AI. So it might be different relative to how people construct their investment strategy. As a generalist fund, we try to be very acute on what's going on in the market. And I think over the years, when I joined, we were just launching our first fund. Basically, we were much more focused in the beginning of last decade in consumer products, and so a lot of the markets were still untapped. iPhone was just getting its mass usage. So in the first fund, we've supported a number of interesting consumer products like Shazam and Chess.com. So it was actually more B2C related and a little bit of marketplace related. As the funds continued to evolve in Fund 2, we've actually switched the business model into, as you said, like B2B and tech-enabled solutions. And then in Fund 3, from which we are investing on the early stage side, we're now 90% focused on B2B software, as this proven to be like the most interesting model in terms of predictability of outcomes and downside protection for you as an early stage investor. As for the markets, when we looked in our first fund, and we did have some number of B2B solutions that we back then as well. We saw the rise of the restaurant industry with point of sale systems, coming online with Toast and Square and other solutions. And so basically, when we saw that trend, we thought, okay, what other solutions are needed for restaurant technology within the restaurant technology ecosystem? And so after scouting the market, we've settled on the inventory management, and we pretty much talked to all the companies that existed in the market back then. It was about 5 of them. With 2 of them, we got really deep. With one of them, we've made an investment. It's a company called MarketMan, with whom we've successfully scaled and basically sold that a few years back to a private equity group in the US. And a funny fact that the founder of MarketMan, Noam Wolf, actually joined us recently as a partner. So going from a early journey with a founder helping him scale the company, raise capital, and assist also in the exit, and also now working side by side, but in other capacity, and building Flashpoint further on. As for the fund two was more around how do we broaden that hospitality angle. And so we saw the rise of Airbnb was the second trend that we saw mid the last decade, and one of the companies we backed was Guest Team, and that domain, which also propelled quite nicely from about $1 million of revenue, very, very high, and raised over $200 million of growth capital from reputable US and global investors. Still present there, helping them basically continue to flourish. But as we're heading into this decade, I think a lot of the point solutions and in industry, like in restaurant space, there's a lot of solutions. It's very hard to innovate in that specific industry. And in travel, it's you can still find niches. One of the companies we backed was Mize. Continued to thrive in this OTA space, but we focused more attention in fund two into real estate technology, like companies like Offers R&D, which we also recently sold to a private equity group. And in fund three was more about construction. We saw that post-COVID, especially, the younger generation becoming middle managers and having a seat at the table in terms of how do they want to run the business. And so, basically that transition from, hospitality to, really prop tech investing to construction. And fund three is a lot about construction and construction automation. It's a huge market, $1 trillion just in the US alone plus. And so very fragmented, but there is, interesting niches, and obviously there are big companies like Procore and Blankret, but there's still, quite a bit of room to innovate there. So there is, more and more legacy industries which are slow to adopt technology or getting online. And, it's our job to basically see, what's the next, big sector that is going to get online and into the cloud. And we try to invest ahead of the curve. That's our job.
All right. So as you mentioned, a couple of exits already, reflecting on these successful deals and exits, such as Guesty, Chili Piper, Chess.com, Borzo Delivery. What key lessons have you guys learned about identifying and nurturing high potential startups in the tech sector?
Yeah, great question. And I think as we are maturing from some of our early investments in the previous decade, I think that's when you can really reflect on what has performed well, and what has not. And Guesty specifically, we're still a shareholder, so it's a large company these days, and we're still quite active across the across the sector, not just in Guesty but in other companies as well. But I think it's all about, at the end of the day, it's all about, I think, two things. It's about Tom, and it's about the founder's vision and their ability to form great teams. Because, if you don't have a big Tom, it's going to be very hard to build a large business. You continue to unlock, extra markets. It's almost like running a new business. And so that's the biggest challenge when you focus on a company that has a very limited time from the beginning. And so, if you look at how, value is constructed, even across public companies, the companies that, whose stocks tend to grow over large periods of time, not fluctuating from 1 to year returns, but, in terms of a decade, how house value is being constructed, you can see a very clear pattern that the companies who tend to grow in 10 years, 10 times in the public markets, they tend to have their revenues also grow, 5 to 10 times, or plus. And so, that basically gives you that even in the public markets, it's all about, capturing the market. Obviously, whom to focus, et cetera, is sort of the second layer, because there's a number of companies that work on large markets. The question is how competitive they are and whether they're number one, and can they have defensible mode, et cetera. But I think if you don't focus on large markets, you can't really build a big business. So you can build a business, and like for instance, MarketMan is a very successful outcome for us. We made over 10x return on this one. However, the market size for inventory management solutions, it's a fairly limited market. So if you run a small fund, you can make it work for yourself. But as we have scaled our fund structures as well, from a $25 million fund 1 to $100 million fund 3, it's much harder to return substantial amount of return from a company that can grow to like $10-20 million of revenue. You really need them to build category leaders, and or at least to be like in the top 3 player in those niches, to build like multi-$100 million valuation, so you can make fund returns. I think the second thing that we've perhaps sometimes underestimated is how hard international expansion market by market really is. It sounds like, okay, I've got this product in this specific geography, and I can just go and replicate that, that same product and
it's not
same
like
business
that.
model. However, when you get into the realm of actually building and, going after clients, everybody's unique. There is like sometimes different, like a little bit different regulations. There's different, product needs. You might have formed a great team in one location, but you have nuances, what it takes to form a great team in another location. And so typically it's not the founders who are launching those markets, but it's hired individuals. And as much as you try to hire entrepreneurial talent, it does take a while to crack it. And so, expecting that, you can just, take from an Excel model, something that has, gotten to like 5 million of revenue, and then, I'm going to multiply that times 4 because I'm entering 4 new markets. I mean, from an investment standpoint, it might sound, realistic, but, there's a lot of nuances in terms of like, will it really work? And so, I think you really need to like, be very conscious of your of your hypotheses about how easy it is and how seamless it's going to be in like scaling up. But in some business models, that's the only way to grow. And but coming back to the first point, so if you can find a company that operates, in the large market in the US, and it's the largest market, the largest software market, it's the most competitive one, but it's the largest market. So or they have to like go global from day one. So if you can find those companies, and that's the companies we try to focus on these days, it's less about market by market expansion, but purely like go after the US or global markets, due to scalability constraints that tend to arise over time.
All right. So we're going to talk about the early stage companies. So in your extensive experience, what are the critical factors you consider when evaluating a potential investment, especially in the early stage companies? And maybe could you elaborate on the importance of factors like founders, domain experience, or business model economics when you are making the decision?
Yeah, and again, it very much is different, how you define early stage. Different people define it differently. So for us, early stage really starts when the company is really making revenue and making, like 6-7 figure revenue, right? So for us, it's about like having that, 50, 100, 150K of monthly recurrent revenue, because we're more focused on B2B software these days. So although, might not sound like, early for early stage founders that are just starting out, and, they are only dreaming to sort of get to that 1 million, that's where really, the work sort of begins in terms of, building that into, large, sustainable business. I think there is if you're running a B2B software company, I think the probably most critical metric for you is net dollar retention. This metric, although might be like quite hard to achieve in the very early phase of the company, when you're still trying to figure out that go-to-market strategy and who's your ideal customer profile, and you haven't really built out the solution in full, but having in mind that, as you scale the company and you proactively think about like how will, the existing users will, continue to adopt the product further, and how do you monetize that product in the correct way so you can capture more value as the company is growing and is consuming more is fundamental to running a software business. I think with, over the last decade, when we started investing in B2B softwares like 7 or 8 years ago, I think MarketMan was actually our sort of more proper, cloud software company. And so, the market has, fundamentally, became much more competitive than it was, 7, 8 years ago. And so there's nearly like a couple 100,000 software companies that exist in the market. And so, differentiating on them is becoming, quite also an important factor in terms of, can you, do you have a cross knowledge sharing across other domains? And so I think, so coming back to your point, like what are the successful criteria in terms of like defining? For us, it's about figuring out do you have that net dollar retention mindset? How proactively do you think about gross churn and net dollar churn in terms of your ability to build customer success teams and expand? And how well do you really understand your go-to-market strategy in terms of like who is your ideal customer profile? How much are they willing to pay for the solution? And do you have the right sort of channel product fit for your solution? Because it's very hard to sell going outbound a solution that costs like $3,000-$5,000 a year. So it's almost next to impossible to build healthy economics around that. So but then coming back to, does your products really solve value for in order for you to charge $20,000, $30,000, $40,000 for a solution in order to you have that channel fit in terms of going outbound. So I think as there's much more data and knowledge in terms of how to build software companies that exist in the market today, we really seek for founders who sort of thought about those problems well in advance and really understands what he's building, because the time to figure this stuff out, if you had sort of months and quarters 10 years ago, like now with proliferation of software, you really don't have that luxury of time. So you really need to know what you're doing. And again, team is probably the most important part, is because at the end of the day, you're partnering with that set of co-founders and their ability to hire great people. And they really need to hire A-team players, because otherwise it's very hard to make a very sustainable business term.
All right, so let's also talk about the growth depth, the product structure and impact, and in the context of Flashpoint's growth depth product, how do you see this complementing traditional venture capital financing, and what unique advantages does it offer to the VC-backed startups?
Sure. I mean, every business model is unique. And you oftentimes in certain sectors you really see a very strong hardware component to the product. And so when capital is cheap, and as it was during sort of pandemic and maybe a few years before that, you could have even in the early stage and even late stage, you could have used equity dollars to basically fund your growth. I mean, as the capital became substantially more expensive, and as we've seen the ecosystem not dry up, but substantially just its ability to fund venture-backed companies. There's a lot of hype around AI, but if you check that out, then the availability of funding has radically decreased. And so what that means is that you have to look for other forms of non-dilutive capital in order for you to scale the business. And debt financing is one of them. Traditional banks, they have their own sort of challenges, especially now with commercial real estate also being sort of in certain geographies under pressure, with their ability to tap into the Silicon Valley Bank also being in the news last year, also impacted the bank's ability to provide that type of more high risk financing to growing companies. But venture debt and growth debt has alternatively stepped in and basically replaced some of those equity dollars that went into the company during pandemic, and now it's becoming a substantial part of how companies are looking to grow. Venture debt growth debt is also like a great instrument when you're looking to back an M&A. A lot of the consolidation right now is happening. And when you're, buying a company that has a little bit of EBITDA, maybe all the growth has dissipated, but you don't want to dilute yourself and buying a company that you can sustain, at least, over the next like 24, 36 months until the markets become sort of more alive with debt financing, and because you also have a collateral, which is also important for those backers, is that you have got some assets that you can actually back that debt. And so when it comes to Flashpoint, one of the things that we wanted to offer our founders, and we do tend to focus on although we're going after global companies, the fundamental thesis of Flashpoint is to focus on founders from Central Europe and Israel, as we find those regions to have scarce local demand, and we believe that scarcity yields creativity. And so because those regions many of the times are also quite underfunded. So the innovation and creativity comes in terms of like efficient go-to-market strategies, and and so we wanted to also offer additional product to the founders. If we don't back them through equity, it doesn't necessarily mean that we won't back them through other forms of capital. And so you might not invest, for a variety of reasons. Maybe valuation is too high. Maybe you don't see enough risk return profile. But a growth debt product has a different risk return profile. So it's more about sort of consistent growth and less about trying to hit like a 40-50% IRR on your investment. It's more about can I return the loan and make that interest payment, and also maybe have some economics on the one side, but it's much less dilutive. So that's why it's also attractive to the founders when the ecosystems have indeed dried up, and so we see quite a bit of demand for that product over the last 24 months.
All right. So you touched based on also on international markets and expanding to international markets, and you also touched based on working with the local talent. So Flashpoint invest in technology companies that are not only achieving significant international revenue, but also they are leveraging on the local talent, right? So how does this approach contribute to the success of these companies, and what challenges and opportunities does it present for you guys?
We're both a local investor and a global investor. Flashpoint has offices from New York to London to Warsaw, Riga, Tel Aviv, Limassol, basically covering, and we have a couple of partners that sit in also Spain and Switzerland. So we have quite a broad representation across Europe, and also present in the US. So that allows us to, on one end, tap in very locally, and utilize the network of all of the local partners that are set. On the other side, because companies are becoming more and more global, today, there's, especially when it comes to collecting money, if it was, an issue, a decade ago, nowadays, everybody, has got Stripe and, other, forms, and it's much easier to, sign documents and conduct international business. And so basically, you also can cross-share all of that network of talent that you tapped into. And so internally we have built, a HubSpot on top of HubSpot CRM. We've built a network of people in agents, and who you can basically talk to and help you with, hiring decisions. And also, because we have a portfolio of about 70 companies, key managers are also rotating, across, a number of them, and they strive for new challenges, and they want to, also switch gears, from one company or one industry to another industry, and that allows you to also, tap into your existing portfolio if you know that that key executive is looking for the next challenge, basically to assist him in finding a new challenge across some of our other portfolio companies. Obviously, we're not proactive in poaching, our existing management teams, but if there's a need and the person has delivered and his role inside the company and is looking for the next challenge, we tried our best to not lose great talent and place them into other portfolio companies that could benefit from that.
Yeah, that's fair enough. And for our listeners, we are doing this session because we had many guests from several software companies, blockchain, AI, fintech, gaming, esports, and other. And this ties all of those companies together because everybody is sometimes looking for the investment. So a lot of things to learn from this podcast. So we're also going to touch base now on the secondary liquidity investments. So Anton, can you discuss the strategy behind providing secondary liquidity to early stage investors and employees, also including the founders, and how does this impact the long-term growth and stability of these tech companies?
Sure. I think as we've been investing in basically over the last decade, one of the trends we've observed is that, a lot of companies are, ultimately staying private longer. You can see it from the number of IPOs getting decreased. What's the size of the IPO that, historically you might have a company that had, like 30, 50 million of LTM revenue that was maybe shooting for that $100 million mark. If you look at the previous IPOs that have been, the market over the last, 24 months, typically they are, $500 million revenue. Like Klaviyo is like a good example. Like Airbnb is like multi-billion-dollar, revenue business when it did IPO. All sort of started with like Facebook in a sense, a decade ago. And companies are trying to stay private longer for, their own reasons, but obviously it's much easier to run a private company than it is to run a public company. And so for that matter, you basically have a lot of early stage liquidity, tied for, quite a number of years. And so, after, 5, 6, 7 years, being a shareholder, you start to question yourself, well, I kind of got this great investment that I did. And so, but how can I monetize the capital appreciation, right? And so, historically, a lot of the stuff has happened around rounds financing. So you might have a round, then there might be some secondary, around that round. And so you might get some secondary liquidity during that round. But, those situations are quite unpredictable. Many of the times those, from round to round, you might have, 24 months, because, you don't raise capital like every quarter or even every year. During COVID, people did, had compressed, timings, but historically you would have like 18 to 24 months is that round to round period during which you're, deploying that capital, growing, and before you go out and raise another one. And so ultimately, we saw it from the need of our existing portfolio companies, that, there are, people, you might have a co-founder, there's 3 co-founders, and, one of the co-founder after like 5, 6 years, it sees that the company got into like 20, 30, $40 million of revenue. His role as in this company maybe not as important as, as it was before. You've got great engineers already, and, you might have the VP engineering join that, is maybe even more capable than the current person. And so, there is a vacuum created. And so, people tend to utilize their best skills. And, some people are just great starting companies and, being entrepreneurials, and then less as, successful top managers and established business. And so they want to exit. So who do they exit to? And so we've basically, introduced to our, again, some of that region of Central Europe and Israeli markets. We've introduced that product to basically assist them in their next journey, right? So, and so that's where, we see a lot of, especially also synergy across Flashpoint, because we tend to know those founders very early on when they build that early product, and we might have invested, we might have not invested, we pass them on to venture debt then. They might have invested, they might have not invested, because, maybe there was no interest for debt. And then, you see the company blossom and gotten to 30 million, 50 million of revenue. and they're looking for that secondary liquidity. And so then we have another shot at that business, basically for the third angle. And so we have already like a number of those relationships that have gone full circle. And so, and also, vice versa. So you might see a secondary fund, getting to know a founder, but it's maybe too early for them, because it's only like 10 million or 15 or $20 million of revenue, and they tend to focus on companies that are sort of 30, 40, 50 and above today. And so, they pass on them to venture debt. And so that's the synergy that we've created, on Flashpoint, being quite focused on that Central European and Israeli ecosystems. We see a lot of value in terms of, like people must get rewarded for their work and, time that they've spent in building and creating value in companies. And so, as for the existing investors, obviously it's also important, for some of the, existing option holders who, some of the stuff that we buy and some of the programs that we've established is basically we buy some option pools. And then there's a number of players that also do that. But it helps also CEOs of those companies show that there is, actual capital appreciation, that, employees that join, they also join, on one end for the vision, but they also want to get, financially rewarded across years, and having plan that group investors that can basically monetize that shareholder value over time is super important when you consider about joining a company and as a financial package that you will get as part of that as part of the compensation plan.
All right. So as a closing question, let's look ahead and envision Flashpoint's role and impact in the evolving tech and startup ecosystem. So especially given the dynamic nature of sectors like healthcare, IT, and financial services. So how do you envision this?
I mean, we are an investor that is capable to support the company during the life cycle. And I think that's what we've been trying to. I think as the industry has blossomed and attracted quite a bit of dollars, and at some point maybe got a little bit overvalued during the pandemic in terms of some of the investment decisions that were made. When people were investing 50 times, 100 times revenue. For the most part, were not very rational decisions, and there will be, and there is some correction going in the market. And I think the firms that will survive through that next decade will be either very niche specialists that are basically having sectoral expertise, whether that be blockchain or AI or other maybe even just, as you pointed out, sort of like healthcare fund. Or it would be platforms. And so there's a number of global platforms, like A16Z and many others. And there's regional platforms, right? And so the Flashpoint is basically a regional platform for Central Europe and Israel. And so we do provide access to the international markets, because we do have presence in New York and both London, to that group of founders, and then we have a variety of products for them. And so basically, if you're sort of thinking about like a financial marketplace for founders, that's what Flashpoint is. And so investors can also utilize different asset classes, because debt is sort of not the same as equity, and so late stage is not the same as early stage. And so financial and investors and LPs and institutional can tailor their investment strategy if they want to invest into Europe and Israel through a variety of our products. But when we build our organization, we focus on founders and what can we offer them. And so that's what Flashpoint is building, and we're only in our second decade. It does take a while to build a long-standing brand, but it's a marathon business, and we just get started.
All right, I'm wishing you all the luck with it, and just maybe as final words, maybe you can tell our audience where can they reach us or how they can get in touch, because we do have a lot of founders and fans of this podcast who might be interested in your services.
Yeah, we are, we're very open investors. So, you either go to our website and we have a chatbot, that routes basically you based on they ask you a few questions. And it can write to the right, product and fund manager. You can always, write us, my email is anton@flashpointvc.com. So, you can message on LinkedIn or just write a cold email. We're answering majority of them, unless it sort of gets into the spam folder, then it becomes a bit harder. But for the most part, we do answer people, and so but yeah, being us, we're a quite active investor. We are from the early stage side. We're investing our third fund. We are having another year to invest that fund, and so we're looking for great companies that are solving interesting problems in large markets. So ping us.
All right. So Anton, thank you so much for your time once again, and thanks to you, our audience, for joining us today. Make sure to send us an email to podcast@hipther.com if you want to be on the show. Anton, wishing you a lovely day ahead, and to everyone, take good care.
Thank you, Zoltan.
And that's a wrap for this section of Hipther Talks. Thank you for being a part of our journey today. Don't forget to tune in next week for more insights and discussions. Stay connected with us on Spotify, YouTube, Google Podcasts, Amazon Music, Apple Podcasts, and more. Until then, keep exploring and keep growing. We'll see you next time.